Those soaring tech stocks are a reflection of the thirst for all things AI. You can see it in the private markets, too, where valuations are also soaring. Cursor is an AI coding startup that competes with Anthropic and OpenAI. SpaceX has now struck a deal to buy Cursor flat out for $60 billion this year or pay $10 billion for their work together. Is this irrational hype, or is AI so different that multiples of 30 times revenue actually make sense? That's what our next guest is wondering. Bradley Tusk is founder and CEO of Tusk Venture Partners. It's good to see you, Bradley. Is that about the valuation for this deal?
Yeah, I mean, I'm definitely at least unsure of the answer, right? So if you just look at the fundamentals, Cursor had revenue of $2 billion. They're being acquired for $60 billion, so that's a 30 times revenue. SpaceX itself is valued at, if it gets to a $2 trillion valuation in the IPO, somewhere between 108 and 120 times revenue. OpenAI at a $1 trillion valuation would be 40 times revenue. Those are really big multiples. And it is possible to say that, you know, the AI situation is so radically different than anything we've ever seen before, that the companies that have a true foothold in it are going to become so exponentially valuable that any price and any multiple makes sense. But especially when you think about companies like OpenAI at a $1 trillion valuation, there are only 11 companies on all of the markets across the world that have a $1 trillion valuations. There are 44,000 listed companies across all exchanges and markets, and only 11 have $1 trillion. So even if you believe that OpenAI will grow into that valuation, if you're buying it at a $1 trillion valuation, how much gain is there really going to be, and how long is that going to take, and why should you hold all of the risk until that happens? So It's hard for me to see why somebody would you know, when OpenAI goes public, want their shares.
Do you have a point of view on what can be done, what should be done to try to get companies to go public a little bit sooner?
Yeah, I mean, I think that, you know, because the real answer is that a lot of the pension funds and endowments and others that fund late-stage venture capital funds should stop giving them so much money, because for as long as, you know, late-stage VCs can deploy hundreds of millions of dollars into individual deals or even billions and collect management fees on giant AUM, they'll keep doing so because it works out really well for them financially. For founders, especially if they are worried about facing the scrutiny of public markets, for as long as they can just kind of keep getting the valuation up and selling shares on the secondary market in one way or another, it works well for them. And so, you know, there's a little bit of this Ponzi scheme that everyone is engaged in, where the combination of public pension funds and others needing to sort of just deploy capital, venture funds and private equity funds just wanting to collect as much in management fees as possible, and founders being able to sort of unload enough shares secondary to not have to really worry about going public, is that this whole thing just kind of keeps going on and on.
Right, and I would say
so
in some ways, if it were a Ponzi scheme, or you thought a little bit with the private equity troubles lately, it might be the string that pulls out the ball of yarn. But the returns of this ecosystem you're describing justify its existence because you keep having OpenAI and Anthropic and that. So, but it's
for
crowding
everyone
out
except retail and institutional investors in the public markets, and for the employees of these companies who can't sell their shares in the secondary market. You sound like the Republican
chair of the SEC, Paul Atkins, right now, right? He wants to make companies public again. I think he might be right.
Yeah. And look, one way to do that potentially is to tighten the rules around what major, you know, institutional investors can and can't do. And perhaps if, for example, public pension funds, which are subject to a lot of regulation, were told, you can't just keep giving money to all of these private equity and venture funds who are just deploying it into crazy valuations that typically get cut by 50, 60, 70% when the companies go public, say after 6 months or so, that you can't keep deploying capital to these guys. You know, that might start to change it. But yes, I mean, look, Uber, as well as I was lucky to be able to do on my shares, and I got them at the Series A mainly, probably would have made more money had we gone public a couple of years sooner. Now, look, I do understand that you want a company to have, call it at least 500 million, closer to $1 billion in revenue. You do want them to be profitable. You do want to see a path for that to increase significantly. So it's not like every company should just go public. And I think the SPAC phenomenon was maybe an argument against everything we're talking about right now.